Hello YouTube, this is the Average Investor here again. This is my next video on Warren Buffett's interpretation of financial statements, and this one will specifically focus on the cash flows. And this is again the source material for this is Warren Buffett's interpretation of financial statements written by Mary Buffett. And this video will have basically focus on the capital expenditures and also tracking stock and bonds sales and repurchases. So the advent of the cash flow came about because of accrual accounting. And accrual accounting basically is when you when a customer places an order with you, you sell them a product, but they don't give you the money up front. They say that they'll give you money in so many days later. So in order to keep track of all this, the cash flow was added on to actually follow the actual amount of cash flowing in and out of the company. And so a cash flow is made up of the operational activities, the investing operations, and the financial activities. And Warren Buffett specifically concentrates on the capital expenditures in a cash flows. The general rule is basically any company with a durable competitive advantage is one which has a smaller portion of its earnings for capital expenditures for continuing operations. So here's an example of, again, Coca-Cola on the top and Sony on the bottom. And you can see that the capital expenditures for Coca-Cola on the top are about 1/8 or 1/7 of their operating income or operating cash flow. And if you look at Sony's, you can see that their capital expenditures are sometimes even greater than their operating cash flows. So this is a very key topic that one has to examine on the cash flow. So if you want to compare the long-term expenditures versus net earnings, you can look at the capital expenditures in relation to the net earnings by adding up the company's total expenditures in about 10 to 5 years, and then compare that figure with the company's total net earnings in the same 10 to 5 years. So a company that uses 50% or less of its annual earnings for capital expenditures is usually a company with durable competitive advantage. In our example, I added up 5 years for the capital expenditures and net income, and for Coke it came out to be about 26.6% of its net earnings goes to capital expenditures, whereas for Sony's, over 60.5% of its net earnings went to capital expenditures and not essentially retained earnings. So from this you can see that capital expenditures can be and is a major cost to a company. The next thing to look at was essentially stock buybacks. This was actually alluded to in the previous video of the balance sheet, and essentially just looking for companies that buying back their regular shares. So this is the end of this review of Mary Buffett's book, Warren Buffett and the Interpretation of Financial Statements. I will have future reviews online, and I hope to see you then. Thanks. Bye-bye.